Does preparing for retirement keep you up at night? Well, let us help. In our free ebook, 5 Essential Steps to a Well-Funded Retirement, you'll learn how to save, how to potentially make up for lost time, how to fight inflation, how to create investment strategies to help protect against recessions, and more. Get our free ebook now at TRADEway.com/retirement. That's TRADEway.com/retirement. Hey guys, I'm David Mitchell, founder and CEO of TRADEway. What if God Himself gave you a blueprint for how to handle your money? Well, the Bible is a practical book. Let's dive in and see what it has to say about wealth, about risk, about leverage, and about investing, and uncover how trading in the stock market can be a powerful tool for moving towards your biggest goals. We're so happy you're here. This is The Word on Investing. Hey guys, welcome back to the podcast. Today I'd like to talk to you about how to meet your financial goals for people at different stages in their life. So let's talk about if you're high school age or college age or really any age less than say 30 years old where you have not had time to, have a lot of savings in a 401k or anything like that. And so you're starting out with a relatively small amount of money. Well, the normal rule is, we call it the 80-20 rule. You want to have about 80% of your total money into long-term, more highly diversified investments, and they're longer-term investments. They're not short-term trades. So that's what you would do with about 80% of your money. And with 20% of your money, you would do the shorter-term trading that you learn at TRADEway.com. Now, here's the problem with that. If you're really young and you don't have a lot of money, let's say you don't have $300,000 or more, then you really can't go by the 80-20 rule, because God has put a rule out there in the universe. It's called the risk-return trade-off rule. And it basically goes like this. The amount of money that I have the potential to make for my family and myself is directly proportional to the amount of risk I'm willing to take. Now, we're talking about educated risk, where you know how to do the trading, and that's what TRADEway.com is for, is to get you that great education. But the problem with the principle, it's like the law of gravity. You can't get around it. And so if you're taking less risk, you're going to make a lot less money. Well, if you're starting with a small amount of money and you're making less money because you're over diversifying it, you're never going to get there. So when you're starting with a small amount, you probably want to put all of it in the one best trade that you can find. Now, let me give some parameters. Let's say you're trading with $500 and that's what you've got in your account, or $1,500 or $2,000 or maybe $3,000 or up to even $5,000. Why don't we just say less than $10,000? Well, you pretty much need to put all of that in the one best trade you can find and see if you can triple your money in 3 months or double it in 3 months, including your losses. And, it's kind of like this. People say, well, aren't you breaking the diversification rule even in the Bible? Well, you are, but think about it this way. If you started out with, say, $50,000 that maybe you had inherited, and you just started out and you didn't follow our rule for small money trading, you just started out with $50,000 and you broke rules like everybody will when they start out, and all of a sudden you lose down to $6,000, all you got left. Do you really think you've got an uncle or somebody in the world that's going to give you another $50,000? No, you don't. So you lost it. Whereas if you're starting out with $800 and you try to triple it and you lose all of it, you really well might have someone in the world that might loan you $800 to start over again. So it's not as risky to put all of it in one trade as it would be if you put $50,000 in one trade. It's just common sense. But the main thing is, if you over diversify and take too little risk, you don't even have a chance of multiplying that money. So at a young age, you got a whole lot of life left, you hope, on this earth, and that gives you more time to build the money. And so even normal financial advisors feel like that the younger you are, the more appropriate it is to take a little more risk than if you're older. So take more risk. Just take the money that you've got in that account, put it in the one best trade you can find. Now, how do you know that? Go out to TRADEway.com, take advantage of our education, and learn how to recognize patterns that stocks tend to make, and don't get in one unless it's making one of those recognizable patterns and it's at the proper buy point, which are all things that you're going to learn out there. It's really exciting and a lot of fun too. But at that young age, my point is you're going to diversify less and take more risk. Even if you had as much as 10,000, probably at that point, you would divide that into 2 groups of 5,000 and not put more than 5,000 in any one trade. So that way you could be in 2 trades, different stocks, maybe different industry groups, and diversify a little bit even at 10,000. Certainly at 30, you would divide that up maybe into 3 groups of 10 and so forth. But if you've got $5,000, $6,000, you're pretty much going to put all that in the one best trade. That's the best way to get there, because think about it. We advocate small money trading anyway. And so if you keep the rules and when it goes the wrong way, you stop it out appropriately, you're not going to lose all of it. So what you're going to try to do is double it, say in 3 months. So if you're starting out with 5,000, you double it. Now you've got 10. So just 3 months later, now you can start diversifying a little bit. All right. So that's the principle there. So yeah, you're sort of breaking the 80-20% diversification rule that we generally believe in. And just remember this, though, by taking more risk, you'll get there more quickly where you can build that account up to maybe 50,000, 60, 70, 80,000. At that point, then you can start keeping the 80-20 rule. You put 80% in safer, more diversified positions, maybe put it into Amped with TRADEway, where we'll manage that for you and take the 20% and keep trading with it. And so that's how I would deal with it at that young age. Now, when you get into 30 to 50 years old or so, you should be able at that point to keep the 80-20% rule. And if you're in that arena, then you want to remember the 3 financial fables that we talk about at TRADEway in step 1. And Wall Street wants you to think these 3 things, and they can make it really difficult to have potential to build any kind of wealth. The first one is you must buy and hold. Secondly, you must diversify. And thirdly, you can't know the future, which is telling you can't trade because you don't know when a stock's going to go up or down. They want you to buy into those. And really, none of those are true because they, if you understand what they mean anyway, they're not true because they trade with your money and they don't tell you that. Now, the buy and hold part, well, the 80% money rule, we believe in buying and holding, so to speak, not maybe like they do where you hold it forever, but basically. But you would have longer term investments, say 9 months to more than a year, and more highly diversified appropriately. And that's where we can help you out with our Amped division at TRADEway. And the 20% money is where you would do less diversification. You would use the O'Neill rule that I taught in a previous episode. Go back and listen to that if you want to. And you would actually do trades that last on average 2 to 3 weeks. And you would do a lot of these kinds of trades when the market presents a good pattern and a good buy point. And we've talked about all of that too. But by doing this with 20% of your money, you're raising the risk a little, which gives you the potential for more return, obviously. And you want to mix those two together. And so what happens as you continue your trading with the 20% and you're keeping the rules, and as you begin to do well, that amount of money that was in your 20% trading money grows, doesn't it? So after it grows a certain amount, maybe 20% more money than you had, take 10% of that new money and put it over in the 80% money and be more careful with it. And then trade for 2 or 3 more months or maybe a couple of quarters and take the new money, take maybe half the new money you made, put it over in the 80% money. And that way you've got a real nice system going where you have the potential to begin to build wealth in those middle years. Now, what about when you're, say, 55, 60, 70, and older? Well, at that point, most of the world would teach you, say in the MBA programs or wherever you try to learn about investing, that the older you get, you want to start taking almost no risk and maybe just put all your money in annuities or CDs or something like that. And the problem that you have with that is that inflation will eat your money up. So you really don't want to follow that pattern. Really what you want to do when you have skill sets like you learn at TRADEway, it gives you the ability to continue the 80-20 plan like we described for the Middle Ages there. You can still keep 80% of your money in Amped and let that grow safely. And when you have down markets, bear markets, we might just go to cash, which is better than being in the market at all at certain times. Or we can do inverse positions that have potential to make money on the way down in those major corrections and bear markets with your 80% money. And that's all great, but you could keep trading with the 20% money. What you could do if you want to is move that down to 15% that you trade with and have more in your longer term safer money. And as you do that, you could even begin to do some things like buy some stocks that are not growth stocks, but they're value stocks, and they earn dividends. And you can accumulate enough of those stocks where the dividends you make per year are great money that you can live on and do different things with, travel and things like that. Another thing you can do, some people get into real estate in those years. I personally don't. What I like to do is write covered calls. It's a lot like being in real estate, but you're using stocks. Instead of buying a house, you put that same amount of money into some great stocks and hold those stocks. And every time the stock dips, they don't ever just go straight up. They zigzag up, right? So when they do the little retracements where they're moving down, you write a covered call. Now, we teach that in step 4 in the TRADEway education. And it's fantastic because your balance sheet grows as you're in a bull market, because in a bull market, your asset potentially gains value. That's like your house gaining in value, but it's a stock. And it gains value the whole time you're holding it in a bull market. And then when it dips, you're making income. So that looks good on your income statement. It's like making rent. The cool thing on writing calls is you can make rent twice a month instead of once a month, like with real estate. So you really have the potential to have income coming in twice a month rather than once a month as with real estate. And so it's really cool. So if you had a mix of dividend stocks and you're writing covered calls, you're creating enough income to travel, to live on, and different things like that, but you're still well invested with your assets in the stock market. And you still have 80, 85, maybe even as much as 90% of your money in Amped by then, and we're just managing it very safely for you. So that's what I would recommend as you get into those upper years. Now, let me give you this specific scenario, though. What if you didn't meet us until you're 70, or let's just say 65, 70, and your previous financial advisor had lost 30 or 40% of your total money in the world in the most recent bear market crash? That happens. I have so many clients that tell me that. Well, if you continue with their plan, which is strictly buy and hold, you just don't have enough life left to make back what they lost or to get ahead. And that's where TRADEway is so helpful, because it gives you the potential, as we say, to take 20% of that money and trade with it. And the trading, you would take a little higher risk, which gives you the potential for higher returns, according to God's law of risk-return trade-off. And so this gives you the opportunity to actually make back some of the money that previous financial advisor lost. And you don't have to feel like you'll never make it back, because you couldn't ever make it back with buy and hold. It just won't do it. But this gives you the possibility, and it's so great. It's kind of interesting because in the book of Ecclesiastes, God says we should take our money and put it into 7 or 8 groups. And at TRADEway, the first 7, we put those into properly diversified places for the 80% money. But what's interesting is we feel like that 8th group is the stock trading, the shorter term trades, because if you think about it, the number 8 in Bible numerology is the number of starting over new again. And so if you've had a financial advisor lose 30% of your money and you're 65 years old, 70 years old, you might need that 8th thing of being able to start over new and have potential for higher returns to get caught back up and get ahead. And that's what TRADEway can help you do with our educational system. And it not only that's a lot of fun, it's way more fun than buying and holding. Like, it's the fun part. So we hope you get involved. I hope this will be a help to you at whatever age you are, whatever stage in life you are right now. And certainly it gives you the potential then to change your family's financial future going out 2 and 3 generations. And that's really one of the big goals that TRADEway has, is to help Christians around the country do that. So if you love this show, please rate and review it so people with similar interests can find it. We might be a help to them as well. Hopefully we've been a good help with you today, and I hope you enjoyed the show. We will see you real soon.